Let's start off with a new topic that is called as financial ratio analysis. Before we get into what is financial ratio analysis, we first try to understand what do we mean by ratio first, right? We'll have a look at ratio first and then we'll get into financial ratio and then it will be going to financial ratio analysis, right? And the simplest way, if I have to explain what is ratio, the definition that books are giving is ratio is any logical comparison between two numbers. That's it, right? Any logical comparison between two numbers is a ratio. That's it. Now, where ratios help and how ratios help, if we talk about, it's going to help in this way. Let's say if I ask a student that how many marks did you get, just as it is, okay, how many marks are you getting? A student told me that it is 22. I said, okay, fair. I asked another student, कि भाई तेरे को कितने marks आए? And with great pride, he is saying that, sir, I obtained 84 marks. So student A obtained 82 marks, student B obtained 84 marks. Now when you look at this data, 22 and 84, anybody reading this or anybody getting into know this data will feel that student B is a much sharper guy as compared to student A. But if I give you one more data that student A had obtained 22 marks out of total 25. Good. But student B had obtained 84 out of 700 marks, and then you make much more sense that A is the guy who is the intelligent one. You call it as a percentage, we don't mind, and in our language we call it as a ratio, that is any logical comparison between two numbers. The whole ratio analysis is based on one premise, one fact, that isolated numbers cannot give you results that you desire. Isolated numbers can never lead you to the right conclusion, mind you. What I mean to say is, if you look at only 22 and 84, you are never going to get the right result. You will keep getting wrong conclusions if you look at isolated numbers. But these numbers, 22 and 84, started making much bigger sense to us when we compared it with the total. That is 22 is out of 25 and 84 is out of 700. And that's where we are making a lot amount of sense. That's what ratio is all about. Now ratio in simple word is any logical comparison between two numbers, as I said, and when these two numbers are being picked up from the financial statements rather than any damn number, I mean from any damn source, if they are picked up from financial statement, then this is called as financial ratio analysis. Financial statement broadly comprise of P&L and balance sheet, and whenever any two numbers or a group of numbers are being compared from either income statement or balance sheet or combination of them, we're going to call it as a financial ratio analysis. Again, financial ratio analysis is based on the same premise that if you look at isolated numbers of any financial statement, you're not going to get right picture. Few examples of ratio are, say for example, company A has got a profit of 10 lakhs and company B has a profit of 1 crore. Which company is better? At some stage you might feel B is better because it has generated a profit of 1 crore. If I give you one more data, that sales of company B is 50 lakh, so it has generated 20% margin, and here the sales is 100 crores, so it has only generated 1% return. Now for me A is better, and you might be aware we call it as a net profit ratio. Again the logic is same. When isolated numbers are compared or logically with some other number, that is total sales in this particular case, it started making much more sense than it used to make as isolated figures, right? So now what we're going to do is, as I said, financial ratio analysis is any logical comparison between two numbers or group of numbers from financial statement, and financial statement broadly comprise of P&L balance sheet. So now we'll try to have P&L balance sheet, we'll understand it, we'll go through the format, and then it will be easier journey for us to get into the ratios and take a deep dive into what all different ratios we can study, right? So let's look at income statement and balance sheet now. Fair. So, in financial statement, first of all, we look at income statement. See, the income statement that we have got is very, very simple. It is very much similar to the cost sheet that we have already studied under the subject of cost sheet. So, we'll say sales minus COGS, that's going to give you GP. COGS comprised of direct material, direct labor, direct expense, FOH. It is very much like cost sheet, so I am not getting into depth of it. Direct material, direct labor, direct expense, FOH, followed by opening WIP, closing WIP. Factory cost, works cost, that's going to give you COP. One thing that's going to change over here is if you remember the cost sheet topic, यहाँ पे हम लेते थे factory cost, works cost और उसके बाद administrative overheads. But you must appreciate administrative overheads, factory cost, works cost के बाद costing में आता है, and this is a topic of financial management, and under the financial management logics, factory cost, works cost, and then straight away we get COP. You cannot have admin. Admin is not considered as a part of cost of production as far as financial management concepts are concerned, right? So that's the one thing that's gonna change over here. We say factory cost, works cost. Admin will keep it after COGS. So we'll have COP. To that we add opening stock of finished good less closing stock of finished good. That's gonna give me COGS. And sales minus COGS will give me GP. Let's subtract two expenses that are left out in all the cost. From GP, first I'll subtract administrative overheads, and second I'm going to subtract is selling and distribution overheads. That's going to give you the profit that you used to get in cost sheet, or we call it as a business profit, or you can call it as operating profits, right? We call it as operating profits. After operating profit, two things are yet to be adjusted. One is non-operating incomes and second is non-operating expenses. Okay, how do non-operating income and expenses come into picture, or what are the examples of it? See, operating means anything relating to business is operating. What is non-operating then? Not relating to business is going to be non-operating, very simple, right? Operating is relating to business, and hence if you see over here, material, labor, expense, FOH, these are all expenses relating to your business, to your product, and hence it is called operating profit. Okay, what are the examples of non-operating incomes? You can say profit on sale of factory, you can say profit on sale of investment. Apart from that, interest received, dividend received from shares and deposits which are not forming part of your business investments, and less non-operating expenses. Again, the question that comes is, what are the non-operating expenses? Then, non-operating expenses are all those expenses which are not relating to business. And what are the examples of it? It is loss on sale of assets, loss on sale of fixed asset, loss on sale of investment, donation, and it keeps going that way. Whichever expenses are not relating to business, that's going to be called as non-operating expenses. So once we adjust non-operating incomes and expenses both from our operating profit, then we are left with EBIT, right? EBIT stands for earning before interest and tax, and here on, whoever is provided as capital, they start getting something in return. Now, who has provided the capital to us? By and large, we are taking that up in the format of balance sheet, but as of now, three people can give you capital that is needed to run the business. One is debt providers or loan providers. Second, people who can give you funds are preference shareholders. And third and last are equity shareholders. So, if giving something in return as far as is concerned, from EBIT, first we got to subtract interest. That's the debt, people get their interest first. Having subtracted interest from EBIT, you are left with EBT. Then subtract taxes, so you are left with PAT. From that we subtract preference dividend, and you are left with equity earnings. And equity earnings divided by number of shares is going to give you EPS. Again, EPS itself is a ratio. How? See, let's say there are two companies, A and B. A has got equity earnings of 10 crore B has got equity earnings of 100 crore. If someone asks you which company is better, you don't have any answer about which company is better. If I give you some more data that number of shares outstanding in A is, let's say, 2 crore. So that will be 5 per share EPS. And if over here 200 shares are outstanding, then EPS is only 0.5. So we can now be sure that A is a better company. So again, EPS is a ratio. Ratio is any logical comparison between two numbers. When you cannot derive or arrive at any conclusion with just looking at the numbers, then the ratios are going to help. As it did in this particular case, which company is better, A and B, we had no answer, and hence we end up having a ratio that's called EPS. Now going to the next part, we'll try to learn balance sheet format, and then I'm exploding into the types of ratios that we got to learn, right? So let's cut to balance sheet now. Okay, so now we're going to have a look at the format of balance sheet. It's simpler, nothing great into it. Still, we'll look into it so that there is no doubt, absolutely. Balance sheet, if you look on the asset side, first we have got fixed asset. There is nothing that I got to add value to, so I'll skip it as a pill. We have got current asset. Current asset generally comprise of stock, data, cash. And if it is a manufacturing company, then stock can comprise of raw material stock, WIP stock and FG stock. We'll have a split over there. If it happens to be a manufacturing company, if it happens to be a trading company, then absolutely no issue. And last but not the least is miscellaneous expense not written off. That's what we got to write last as a balance sheet. What I got to explain in a bit depth is this, that is capital employed. I'm taking these two things, investments, but first let's get this thing clear and then we'll move on. In capital employed, first we have got shareholders funds. Okay, who can give you capital? Again, the question is, then two people can give you capital. One is shareholder, that I have marked it as A, and another people who can give you money is long-term debt. Very, very careful, be very, very careful. Quite a few number of students fumble over here. That debt is not a part of capital employed. No, you should remember that debt is a part of capital employed. You got to look at capital in the larger context in the sense that by capital we means whoever is providing us money for the business. Whoever provides money for the business is known as capital. And whether you bring money from shareholders fund or equity shareholder fund, that's okay. If preference shareholder or preference investors are giving you money, that is also an investment for us. And last, even if bank has given you loan, if somebody has purchased your debenture, that's what we call it as a debt. Still, it is a part of capital employed and we will keep counting that as a capital only. So that's something where I need your attention. Capital employed, do not forget, it does include long-term debt and bear this thing in mind. Now again, shareholder funds get divided into two parts. One is going to be equity shareholders funds and second is preference shareholder funds. So we have broadly two types of shareholders. And again, if we come to equity shareholders fund, it again gets divided into two parts. That is equity share capital and reserve surplus, right? That's how majorly your balance sheet is formed. Now two things which I need to explain is trade investment and non-trade investment. If you go by the definition, trade investment, you know the normal meaning of trade. It means anything relating to business is trade. I'll repeat, anything relating to business is trade. So all those investments which are relating to business are known as trade investments. Okay, what are the examples of it? What can be the examples of a trade investment? Examples can be investment in shares of subsidiary company. See, making an investment in the share of subsidiary is definitely relating to your business. So investment in the shares of subsidiary is going to be classified as trade investment. Similarly, investment in the shares of associate, joint venture, provident fund investment, the money that you deducted from your employee's salary, that is provident fund, And if you are maintaining a recognized provident fund, then investment, provident fund investment, money kept aside for redeeming debenture, that's what we call it as sinking fund investment. These are all forming part of your trade investment because they do relate to your business. And all the investment not related to business are called as non-trade investment. It's as simple as that. Repeat, all the investments not related to business are known as non-trade investments. What are the examples of non-trade investments? The examples can be any investment which is not relating to business is non-trade. Like say if I purchase a Reliance share today, it is non-trade for me because Reliance is not my business. My business is teaching. Right. If I purchase TCS shares, if I purchase Tech Mahindra, if I make investment in fixed deposits, again making fixed deposit is not my business, right? If I purchase Government of India bonds, that's all going to be classified as non-trade investment. That is investments not relating to business. And one last doubt that we get, and before we jump on to the type of ratios and then we have a deep dive into formulas and concepts of ratios, non-trade investment के examples अभी अभी दिए, investment in shares of Reliance, TCS, etc., etc., etc. Now, what if I receive dividends from TCS? What if I receive dividends from Reliance? What if I receive interest on bonds, deposits, etc.? Where should I put it in my income statement? What this income should go? And then all the incomes arising from non-trade investment. Again, look at the purpose. Non-trade investments are investment not relating to business. And hence, incomes arising from non-trade investment such as dividend from Reliance, dividend from TCS, interest on deposits, etc., 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 in your income statement you should put it under the heading non-operating incomes, which we had after operating profits, right? So that's the basic of income statement and balance sheet that we had to understand. Now we go into the types of ratios. If we talk about types of ratios, there are broadly 7 types of ratios that we understand. One is going to be profitability ratio, which talks about how profitable a business is. Second is liquidity ratio, which talks about how liquid or illiquid a business is. Profitability ratio we have, second liquidity ratio we have. Third is going to be coverage ratio. It talks about how much earning a company has to pay its fixed expenses. Then fourth, we're going to have turnover ratios, which talk about how efficiently the company is able to utilize its resources. Fifth, we're going to have capital structure, in which we'll look into the efficiency and risk involved into the company's capital structure that will comprise of this thing, shareholder and long-term debt. Sixth, we're going to have is cash position ratio, and last but not the least, we'll take up some miscellaneous ratios and then we'll be completing the chapter with miscellaneous ratios, right? So now let's start having a deep dive into the types of ratios. We'll start off from the first, that's going to be profitability ratios. We have 7 different ratios which will talk about the profitability that a business can generate and how to measure the profitability of business in 7 different ways, right? So let's cut to the profitability ratios. It's going to be a good journey. Learning ratio is something very, very important, and if you take a meaning of it, then you will enjoy the journey. So first of the ratios, first type of ratios which we're going to study is profitability ratio, right? The first question that arises is, what is profitability ratio? It can be, it calculates the profitability of a business, how profitable a business is. It is making a really good amount of sense. If you use these ratios, it will add to your investment values a lot if you can get your hands into profitability ratios. So profitability ratio will try to calculate how profitable a business is in terms of profits on sales and in terms of profit on capital employed also, or resources employed, as whatever you might say. Having said what profitability ratios is all about, second, who uses profitability ratios? Then answer is, it is broadly used by shareholders to understand which company should be invested into and which not. Of course, it can be used by debt providers for the same reason. It is used by government to collect the taxes and to ensure that there is no tax evasion in terms of profit and profits that a business generate. But naturally banks and other stakeholders can use it based on the purposes that they have. Now we have 7 ratios, as I said in just a while. So how profitability ratios function, or what are the profitability ratios? So I'll put it in a form of story so that you get it faster and you understand it better. Let's say some of you want to invest in a company, or let's say you wanted to buy the entire company. For the sake of example, let's say you wanted to buy some company's 100% share. All the shares is something that you're looking for. You were looking for a right company, you were searching for it, you were researching for it, and then you came across a company which had got sales of rupees 100 crores. You felt happy, you felt elated that okay, we have got a company worth 100 crores of sales, that's really good for us, it's going to work and all and all and all. But then someone comes and stops you. Okay, man, stop. You cannot invest in a company just because it has 100 crore sales. You also got to look at how much profit the company generates, because that's going to make a sense to you and not the ultimate amount of sales, right? So with that, we looked into the data of profit and we came across that it has got GP of 70 crore rupees. And as we just concluded, we'll not look into isolated amounts, we'll try to have it converted into form of a ratio so that it makes more sense as compared to isolated figures do. So first of the ratios in this series we have is GP ratio. It is followed by, or the formula is GP divided by sales into 100. We have got GP of 70 crore, sales of 100 crore, and that's going to make it 70%. So yes, I guess we have come across a good company which has got sales of 100 crore and GP worth 70 crore. Should we invest into it as a shareholder? Answer is still no. Because if you're investing in a company looking at a GP or a good GP ratio, it might not end up being a good investment, because as a shareholder, GP is something that you don't get in your pockets. Before you get something in your pocket, there are so many expenses are yet to be paid. Like from GP, admin overheads get subtracted. From that GP only, we have to pay selling and distribution overheads. Then we are left with operating profit. To that, we add non-operating incomes. We subtract non-operating expenses from it. So we are left with EBIT. Even shareholders not going to get EBIT also. From EBIT, we have to pay interest. Once you pay interest, you are left with EBT. From there, you have to pay tax, and ultimately you are only left with PAT, that is profit after tax. That is something that a shareholder can expect to come in his pocket. So was it making sense to invest in a company just looking at a GP? To me it is no, because might be a company has lot of GP, but all these expenses after being paid, you are left with no NP. It might happen, it can go that way, right? So for that, we have second ratio, that is what we call it as net profit ratio. It is going to be net profit, that is PAT divided by sales into 100. Let's say net profit in this company is 20 crores for the current year. So if I calculate ratio, it will be 20 crore divided by 100 crore, and that is going to be 20%, right? Now you invested in this company because GP was good, your NP was good, and you're really happy about it. Good. So once having invested into GP and NP, let's look at the next thing. You invested in a company because it had a profitable business, there was sufficient PAT, and 1 year later when you went to company for taking your dividends or taking your share of profits, your directors are informing that we absolutely have no profit. In fact, directors are informing that this year we have 20 crores of loss. Some wonders how it can happen. How a profitable business company can turn into a loss-making company in a span of years' time. And we inquired, there was no extraordinary factor, no fire, nothing. How it can happen? If I give you some more data, you will realize that you had made a wrong investment 1 year back. Why? Because from GP of 70 crore, admin expenses was 50 crores, S&D was 40 crores, and you had got 20 crores of operating loss. Your business was loss making. Then how did profit came? After having made operating loss, or what we call it as a business loss, there was one thing that is profit on sale of last factory. That is 60 crore. Profit on sale of last factory was 60 crore. So I had EBIT of 60 crore, assuming no interest, EBIT I have 40 crores, and if I pay 50% tax, this is the way I got 20 crore profit last year. See, you had made a wrong investment with looking at PAT. I'm trying to discuss two limitations of GP and NP over here. The first limitation, the first issue I have with GP is that GP is something that is not guaranteed that it will flow to me as a shareholder. Because after GP, there are plenty of expenses yet to be paid, like admin, S&D, so on and so forth. PAT definitely it comes into my pocket, I agree with that fact. But the issue is looking at PAT, we cannot arrive at a conclusion because PAT can be distorted, it is not maintainable because of two things that comes in the way, and that is non-operating incomes and expenses. As in this case, there was profit on sale of last factory and you end up making a wrong investment. So which ratio will give me a proper correct picture? The only ratio that can give me a proper correct picture is going to be operating profit ratio. The formula is operating profit divided by sales into 100. This ratio will make a lot amount of sense as it removes both the limitations. जीपी के बाद हमने ऑपरेटिंग प्रॉफिट में एडमिन एस&डी पे कर चुके हैं और इसमें हमने नॉन ऑपरेटिंग लेते नहीं है क्योंकि नॉन ऑपरेटिंग ऑपरेटिंग प्रॉफिट्स के बाद आते हैं. So the distortion are not being considered over here, and that's why I'll consider operating profit ratio as the best ratio, right? Now let's turn the data. Let's turn the data a bit. Say your admin was 30 crore, your S&D was 20 crore, and you genuinely had operating profit of 20 crore. Your business was really a profit-making business. This data, forget it, is anyway not needed now, right? I guess the concept that I wanted to drive home has been driven home, so it's okay. So my point is your business is a profitable business. You are making a good amount of money. On 100 crore sales, you are making 20 crore and you have every royal right to make investment in this company, and you did it. You made investment of it. Year after year, 20 crore profit was happening, that was coming to you, and you were happy. You were happy with this business, you were happy with the investment because you were getting 20 crores every year. Few years later, one of your friend came across and he asked you, what are you doing these days? You explained this story to him, that I purchased entire share capital of a company and these days I am getting 20 crore as a dividend year after year. That's really beautiful life someone can expect. Then your friend also got interested into this kind of investment because who doesn't like freedom? And he asked you one final question, that boss, how much money did you invest so that you are receiving 20 crore every year? How much money did you invest? And your answer made him laugh crazily. You told him that you had invested 1 lakh crores. My goodness. So now, all of a sudden, your friend is laughing because he knows you have done an act of stupidity. By investing 1 lakh crore, if you are making only 20 crore, it is simply an act of stupidity. It is just 0.2% or even 0.02, I am not sure. But definitely that's not the return that one should look from a company. I have a simple contention, even if you had put 1 lakh crore into a saving bank account, forget about FDs, still minimum amount that you would have got is 4,000 crore, and man, you are making an investment into a company which is risky, which is dicey compared to making an FD in a bank, and still you end up having only 20 crore. That's really unacceptable. So with this story, the issue that we wanted to put is that no doubt it makes sense to calculate these ratios like GP, NP and operating profit ratio. But as an investor, what is far more of relevance is you shouldn't get profit on sales, you should get profit on your investments, on your capital. Agreed, there might be good profits on sales, but if it is not good on my investment, that company is not good. Like look at this company. It has got 70% GP ratio, 20% operating profit ratio, but on my capital it is 0.02. And as an investor, I wouldn't prefer this company. So for this, now we have got a series of next 4 ratios which talk about profit on investment rather than profit on sales, right? So that's the purpose of taking next 4 ratios. We'll try to look into the profit that I get on my investment rather than what I get on my sales, and that's really gonna make a lot more sense to me as an investor. And finally, before we cut to those ratios, then isn't GP, NP and operating profit altogether useless? The answer is no. It is useful to the government because government is someone who is not investing into the business. They want profits, they want tax from the profits, tax on the profit that organizations are making, and to ensure that there are no tax evasion, these ratios can help a lot, right? So now let's cut to those ratios which will talk about profit on capital or investment rather than profit on sales. Okay, so next ratio that we're going to have is return on capital employed, ROCE, or we can call it as ROI, that is return on investment. What does this ratio mean? Return on capital employed or ROI, it means how much capital you are employing in the business and how much return you are getting from the business, how much profit that you are generating from the business. Mind my words very, very carefully. Here you only got to look into the profits made from business and investment made in business, nothing else, right? So we will have this way, ROC is equal to operating profit divided by capital employed into 100. Operating profit divided by capital employed into 100, that is precise way of understanding how much capital has been employed in business and how much return has been generated from the business. And if you look at the profit that business has generated, it is nothing but operating profit, right? So that's how your first ratio goes, and it makes a lot amount of sense because here I am not considering the profit made on sales, rather I am considering profit made on capital employed, that's my investments, right? So if you look at the definition of capital employed, it will be equity share capital, it is first of all, plus we have got preference share capital, plus reserves and surplus. These are all going to form part of your capital, and please do not forget there will be long-term debt, or do not forget to put long-term debt into capital. As I said, it is a part of your capital. From that, we subtract P&L account debit balance. From that, one more, okay, why do we subtract P&L account debit balance? Because it is accumulated loss. And if you have accumulated losses, it means to that extent your profits have been, your capital has been wiped off, right? So if your capital has been wiped off, we say that is P&L account debit balance. One more thing that we need to subtract is miscellaneous expense not written off. Right. So it is equity share capital plus preference share capital plus reserve surplus plus long-term debt minus P&L account debit balance minus miscellaneous expense not written off, and very important thing, is minus non-trade investment. This is something which you really need to understand and really need to remember. Why do we subtract non-trade investment? Right. See, if you have marked my words properly, when calculating ROCE, I said it talks about profit generated from the business and capital employed in the business. If you talk about business, अभी हमने example लिया non-trade investments का. So, what is the definition of a non-trade investment? Just now we have gone through that investment not related to business is a non-trade investment. Right? Any investment which is not related to business is going to be called as non-trade investment. Very simple. And if you understand this definition that investment not related to business is non-trade, then I guess it makes it really clear that why are we subtracting non-trade investment? Because it is not relating to business. This capital has not been funded by, it is not utilized in my business. To explain this better, I'll say this way. Let's say there is a balance sheet. Over here you have got capital employed, and this capital is funding the assets that you have generated on the asset side. Okay, what are the assets that you generated from the capital? Of course, fixed assets are being funded by capital only. Current assets are definitely being funded by this, and importantly, trade or non-trade. All the investment are being funded by capital employed only or capital account only. Be it trade or be it non-trade. So if you understand it this way, the capital employed is funding all these assets, fixed asset, trade investment, non-trade, current asset, everything. But out of it, non-trade is something that has not been employed in business. Non-trade ki definition of which is outside business, right? So from capital employed, we'll say minus non-trade investment because that's not employed in business. And here, the purpose of this ratio is only to get capital employed in the business and profit generated by the business. That's one way to look at it. Why to subtract non-trade investment? Another way, I'll tell you one funda that you got to remember throughout the chapter of ratio analysis, and that is, when we say operating profit divided by capital employed into 100, or for that sake any ratio if you take, you got to ensure one thing, that any numerator or denominator when you divide it, it must be comparable or divisible. What do you mean by comparable or divisible? We mean that if in numerator, if you are taking operating profit, It has, okay, now does it include the dividend that I would have received from Reliance? Then the answer is no. Does it include interest that I would have received on the bonds or FDs? Again, the answer is no. Operating profit stops at operating profit, and interest, dividends on bonds, etc. comes after that. That is your non-trade incomes or non-operating incomes rather. So the comparability concept goes this way. If you have not included Reliance dividend, bonds, interest, etc., then these assets shouldn't also be forming part of your denominator, and then they will be making this two as a comparable one. And by that logic, we say minus non-trade investment, right? Now we go to the next ratio. ROCE basically talks about what all the stakeholders of capital get in return. And now we'll keep living one after another, and then we'll see what is left for the others. In the context, capital employed talks about return that everybody gets, in the sense debt, preference and equity. Now we know the priorities, we know the sequence. Whenever operating profit is being generated, always first debt gets its interest. So we'll now look into next ratio is return on shareholders fund. How much profit shareholders will be left after debt has been paid off in the form of interest. So next ratio that now we're going to take up is return on shareholders funds. So once we calculated return on capital employed, as I said, once debt capital has been paid interest, we'll go to the next ratio. That is going to be return on shareholders funds. Return on shareholder fund, that's going to be, we'll put whatever return shareholder gets on his funds, right? So when we calculate return on shareholder fund, this ratio basically tries to calculate what return a shareholder gets against the investment that he has made, right? So if you look at the shareholders investment, first let's look at that. So I'll put shareholders funds equal to equity share capital plus preference share capital plus reserves and surplus. That's what shareholders fund comprise of. Of course, you cannot consider long-term debt because it has been paid. From that, I'll subtract P&L account debit balance, and from that I'll say miscellaneous expense not written off, right? These things will comprise of shareholders fund. Shareholder fund can be identified by 5 different words. Shareholders fund can also be called as net worth, or it can be called as owners funds, or it can be called proprietor funds, and the last name that we have got for shareholders funds is equity, right? So that's how shareholders fund comprise of. And now we got to find whatever investment your shareholders have made, what return do they get, what profit they get in terms of return. So if you look, capital employed has got the profit of operating profit. You know that from operating profit we have to subtract non-operating expenses and add non-operating incomes. Then we'll be left with EBIT. Now you guys think and tell me, is EBIT available for shareholders? The answer is no. Because from EBIT, first thing that we have to pay is interest to the debt. Once we paid interest, we are left with EBT. But even from EBT, shareholders cannot get the right unless taxes have been paid. So from EBT, we subtract tax, and that's where we get profit after tax, and we get the formula return on shareholders funds is equal to PAT divided by shareholders funds into 100. And that's how we form shareholders fund. Equity share capital, preference share capital plus reserve surplus, P&L account debit balance, and miscellaneous expense not written off, right? So we have got return on capital employed, then return on shareholders fund. The second last that we got in this particular ratios is return on equity shareholders funds. What do you mean by return on equity shareholders fund? Or by this ratio we'll calculate what return, what profit equity shareholder is going to get on their capital. So from PAT, if you look, see, with every preceding ratio we are paying one or the other capital provider. After over here we looked at what is total return for overall capital. Then here we paid debt, and then we have got return on shareholder funds. So for shareholders PAT is left. From PAT, if you pay preference dividend, then preference capital is out, and then we have return on equity shareholders fund. So of course, what is available for equity shareholders is equity earnings. So we say equity earnings divided by equity shareholders funds into 100, right? And that's how we get it formed. Equity earnings divided by equity shareholders fund. Now we take up equity shareholders funds. It is going to be equity share capital plus reserves and surplus. That's what we're going to get. Preference share capital is, of course, we are not going to include because it has been paid off. Minus we have P&L account debit balance, and minus we're going to have miscellaneous expense not written off. That's how you get this ratio, that is return on equity shareholders funds. And last we're going to have is return on total assets. Here we take in denominator, that is total assets. Here we are looking from the company's perspective rather than investors, right? Up till this 3 ratio, we were looking from the perspective of an investor, that what an investor gets. Now we'll be looking from the perspective of overall company, that what company's total assets are generating. First, I'll put the meaning of total assets so that the ratio formation becomes a bit easier for you. Total assets will comprise of fixed asset plus current asset plus trade investment plus non-trade investment. See, whether investment is trade or non-trade, whether fixed asset or current asset, in this ratio we say that all assets pertain to company until liquidation. None of the assets are going to go to the shareholders or for the sake any stakeholder unless company goes into liquidation.